Welcome back to Investing Talk Podcast.
Today we're looking at Robinhood markets.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. Robinhood has really reached a critical turning point.
It really feels like it. I mean, for years, the market just saw it as a high-growth company that was just burning cash to get users.
Exactly. And that whole narrative has now been completely inverted. This is a scaled, profitable operation, and the financials. They're showing an almost textbook case of, improved unit economics.
That's the core story, right? And the Q3 results from 2025, they really seem to confirm that shift in a huge way.
A massive way. You saw revenue nearly double year over year, hitting about $1.27 billion.
Okay, which is impressive, but you expect that from high growth. But the profit number is what got me.
That's where it gets really interesting. Net income surged 271% year over year to $556 million.
Wait, hang on. A revenue increase of 100% leads to a profit increase of 271%. I mean, how does that even happen? That's not normal growth.
It's not. And that brings us to the most important insight here. Operating leverage. It just means the earnings growth is accelerating far, far faster than the revenue growth.
Okay, so break that down, like the factory analogy.
It's a perfect analogy. You pay for the factory, you pay for the machines, those are your fixed costs. After that, every new widget you produce is almost pure profit.
So all those huge investments they made over the years in tech and compliance, user acquisition, those costs are now just being dwarfed by the sheer volume of business running through the platform.
Precisely. We saw this trend starting back in Q2 when earnings per share was growing 100%, while revenue only grew 45%. That widening gap, that's the proof of phenomenal cost discipline finally paying off.
That's a powerful engine. But an engine needs fuel, and looking at the balance sheet, it seems like they've got a massive reserve tank.
Oh, absolutely. They're holding over $4 billion in cash and cash equivalents.
And almost no long-term debt, which is maybe even more critical.
It's a fortress balance sheet. There's no other way to describe it. And that flexibility is crucial in a space like fintech that's, always changing. It means they can innovate or make acquisitions without panicking.
And it seems like management has maximum confidence, too. They've got that $1.5 billion share buyback program.
Right. And they already bought back $107 million in Q3 alone. When a company with that much cash starts buying its own stock that aggressively, it's sending a very loud message.
The message being, we think our stock is cheap.
Exactly. It says we believe we're undervalued and we're so confident in our future cash flow that we're willing to spend this capital right now.
So we've covered the what profitability and the why operating leverage.
Yeah.
So how are they actually doing it? I think a lot of people still think they just rely on whatever meme stock is hot that month.
That's the old story. The key change now is diversification. They are absolutely no longer dependent on just commission-free stock trading. The revenue mix is much broader and, frankly, a lot stickier.
Okay, so walk me through those key drivers.
Well, transaction revenue was the big standout in Q3, up 129% year over year. But it was led by the really high engagement products.
Like crypto and options.
Exactly. Cryptocurrency trading revenue surged something like 300% year over year. And options trading, which is this huge recurring activity for their best users, remains an absolute behemoth. It brought in $304 million in Q3 alone.
But hold on, that still sounds pretty volatile, doesn't it?
Yeah.
I mean, is that really diversification? Or is it just adding another layer of high-octane risk? Where are the stable parts of this business?
That's a crucial point, and that's where the non-trading revenues provide that anchor. Net interest revenue, so money they earn from customer cash and margin lending, that increased 66% in Q3.
Which is steady, reliable income.
Especially in this rate environment, but the real game changer for building in predictability is subscriptions. Robinhood Gold has become critical for them.
Right, and subscribers are way up.
Way up. They grew 76% year over year to 3.5 million members. That provides a recurring revenue buffer. These users are committed, they pay a fee, so they're much less likely to leave just because trading volume dips for a month or two.
So let's connect that to the competitive landscape. What's the moat here? What stops a giant like a Schwab or Fidelity from just coming in and taking their lunch?
It's a multi-layered moat, really. It's built around two things. just massive scale, and what you could call the super app strategy.
So scale first.
They've got over 26.9 million funded customers. Their platform assets hit $333 billion in Q3, up 119% year over year. That sheer mass creates a really powerful network effect.
And I imagine huge switching costs for the average user. It's just a hassle to move everything.
It's total user inertia. Once you have your brokerage account, your retirement account, your crypto, all in that one ecosystem, leaving is just too much of a headache.
And the product expansion really points to that super app ambition. They want to be the one-stop shop.
Precisely. They're expanding so aggressively. The acquisitions they've made are really telling. They bought Trade PMR to get into more sophisticated wealth management. Then they bought Bitstamp, which immediately gave them international crypto licenses and a path into Europe and Asia.
And it seems like they're still pushing development hard. Retirement accounts are now fully integrated.
And there are strong rumors about things like AI-driven investment tools, payment partnerships. They're really trying to become this comprehensive platform that captures a person's entire financial life.
Okay, that's a powerful long-term story. Let's zoom in a bit. What are the key catalysts people should be watching for over the next, say, 3 months?
The first big one is the Q4 2025 earnings release. That's probably late January or early February 2026. The street will be watching this one very closely.
To make sure Q3 wasn't just a fluke.
Exactly. They'll want to see two things. First, sustained high revenue growth, especially in those high margin areas. And second, some kind of confirmation that the recent acquisitions are being integrated successfully and are starting to contribute.
And beyond the company's own news, there's always the big institutional money flows to watch.
Always. You've got two key dates on the calendar. Early January 2026, you have the ETF rebalancing flows, which can force huge buy or sell orders. Then in February, we get the 13F filings.
And that's when we see which big funds bought or sold in Q4.
Right. And speaking of institutions, they are already heavily involved here. Institutional ownership is over 93%.
That's huge. That tells you the professional money sees this as a legitimate growth story, not just a retail fad anymore.
For sure. We saw strong cluster buying through the last couple of quarters. Big names like Pinnacle, Nordea, Ritholtz, they all reported bigger stakes. It's a strong vote of confidence.
Okay, what about the more speculative side of things? What's the market chatter, the unconfirmed rumors that could really move the needle?
Well, there are a few interesting ones. First is chatter about an accelerated international expansion, maybe leveraging that Bitstamp deal to launch in multiple European countries at once.
That would open up a massive new market.
It would. Second is the potential launch of a really advanced AI platform for retail investors. Imagine if they could use all their data on retail behavior to build predictive tools for their gold subscribers.
That would be a huge value add.
And then there are whispers about a strategic partnership with a major bank for payments or cash management. And finally, some speculation that they could get even more aggressive with that share buyback program.
Okay, we've laid out the bull case pretty well. We have to address the risks. What's the bear case here? What could derail this story?
The number one risk, without a doubt, is revenue volatility. The business is just inherently cyclical because it relies on options and crypto trading.
And we just had some evidence of that, didn't we, with the monthly numbers?
We did, and it's a really important data point. In November, equity trading volumes fell a sharp 37% month over month. Options were down 28%, crypto down 12%.
37% is not a small dip.
It's a sharp retraction. It proves that activity can slow down very, very quickly when market sentiment shifts, and that puts immediate pressure on those transaction revenues.
So they're still dependent on the retail trader staying engaged. And the other elephant in the room is always regulation.
Always. The company operates under intense scrutiny. The core issue is payment for order flow, or PFOF. That business model is constantly under the microscope. And then there's the intense oversight on crypto, which always poses a headline risk.
So high growth, but with clear risks. What about the technicals? How does the chart look?
Well, despite those risks, the stock has been in a very strong, sustained uptrend. It's up over 200% year to date.
And it's staying above those key moving averages.
Consistently above the 50-day and 200-day, which is the hallmark of a healthy trend. And you've seen analysts respond by raising their price targets quite a bit, pointing to potential upside to 155, 157, even 168.
But it's not at those highs right now. It's pulled back a bit.
Correct. It pulled back from its 52-week high around 153 and is now in the low 120s. A lot of technicians would view that as a necessary and healthy correction.
A potential entry point.
That's how many would see it, especially with that key long-term support, the 200-day moving average sitting down around 109. It looks more like a consolidation phase than a reversal.
So to sum it all up, this is a platform that has really managed to pivot from, being the facilitator of meme stock mania to a genuinely high-growth, profitable financial company.
Right. They're sitting on a fortress balance sheet, they have powerful operating leverage, and they are executing this comprehensive super app strategy that builds a real competitive moat through switching costs and product diversity.
The story isn't about potential anymore. It seems to be about execution.
Exactly. They are at a critical inflection point, backed by sticky subscription products and confirmed institutional buying. The big question now is just whether they can sustain that leverage when they inevitably face that cyclical market volatility.
That's the challenge for you to consider. If you found this analysis helpful and want to stay informed on the financial markets, be sure to subscribe to Investing Talk podcast for our next exploration.